The idea of growing money in America has changed significantly as we move into 2026. What worked a decade ago is no longer reliable, and what worked even 3 years ago is now outdated. Rising living costs, changing tax structures, automation, and shifting job markets mean that growth today depends less on shortcuts and more on alignment with how money actually flows in the modern U.S. economy. The first reality that must be understood in 2026 is that money growth starts with value creation, not financial tricks. In America, the system rewards people who solve problems, improve efficiency, or contribute skills that others are willing to pay for. Whether someone is earning from employment, self-owned businesses, or ownership in productive companies, the root is always the same: income tied to real economic activity. For most people, the foundation of growth still begins with earned income. In 2026, the smartest earners are not chasing job titles. They are chasing skills that compound. Skills related to data analysis, AI-assisted operations, logistics optimization, healthcare support, cybersecurity, cloud systems, skilled trades, and regulated financial services continue to command strong pay because they save companies time and money. In America, salary growth happens fastest when income is connected to outcomes rather than hours. However, income alone does not build long-term stability. What separates those who merely earn from those who grow is how income is allocated. In 2026, consumer culture is aggressively designed to extract money through subscriptions, convenience spending, and impulse purchases. The individuals who grow wealth consistently are those who treat spending as a deliberate decision rather than an emotional reaction. One of the most effective principles in America today is controlled lifestyle scaling. This means allowing living standards to improve slowly, while income improves faster. When income increases by 10%, lifestyle might increase by 3%, leaving the rest available for ownership and reinvestment. This gap is where growth begins. Ownership is the second major pillar. In the American system, ownership does not mean hoarding cash. Cash loses strength over time due to inflation. Ownership means holding assets that represent productive activity. This includes equity in companies that sell real goods or services, ownership in private businesses, or revenue-generating digital assets that are tied to actual customer demand. In 2026, responsible equity ownership remains one of the most reliable ways to participate in economic growth. This does not mean constant buying and selling. It means owning shares in companies with transparent business models, clear revenue sources, and ethical operations. Businesses involved in infrastructure, healthcare services, essential technology, logistics, energy efficiency, and consumer necessities continue to perform because they serve ongoing needs rather than trends. Another powerful growth path in America is business ownership, even at a small scale. The myth that businesses require massive capital is outdated. In 2026, service-based businesses, online consulting, niche e-commerce, logistics coordination, content-based education, and software-assisted services allow individuals to start small while scaling responsibly. What matters is that revenue is earned through service delivery or product exchange, not financial manipulation. Side income in 2026 is no longer about working more hours. It is about leveraging systems. Someone who creates a digital product once and sells it repeatedly, or builds a service process that can be delegated, is operating within a scalable model. America rewards scalability because it multiplies productivity without multiplying labor. Taxes are another critical area where many people lose growth unnecessarily. In the U.S., tax efficiency is legal and encouraged when done correctly. Structuring income through appropriate business entities, using retirement accounts designed for growth, and understanding deductions tied to productivity allows money to remain active instead of being drained. In 2026, financial literacy around taxes is as important as earning itself. Debt behavior also plays a defining role. Not all debt is equal, but irresponsible debt destroys growth. Consumer debt tied to depreciation, such as unnecessary upgrades, status spending, or impulse financing, creates pressure without return. On the other hand, structured obligations tied to productivity, such as tools, education, or business infrastructure, can increase earning capacity when managed responsibly. The distinction is critical in 2026's higher rate environment. One overlooked factor in money growth is time discipline. In America, time is monetized more aggressively than anywhere else. People who protect focused time for learning, building, and planning consistently outperform those who are constantly busy but unfocused. The ability to delay gratification, ignore noise, and commit to long-term strategies is a financial advantage that compounds silently. Another essential concept is diversification through logic, not fear. In 2026, diversification does not mean owning everything. It means avoiding dependency on a single income stream or sector. A combination of earned income, ownership income, and business income provides stability. When one slows, others continue. This balance protects growth without unnecessary complexity. Trust also plays a hidden role in financial growth. In America, trust converts directly into money. People who build reputations for reliability, transparency, and consistency attract opportunities faster. Whether in employment, business partnerships, or customer relationships, trust reduces friction and increases income potential over time. Finally, mindset alignment matters more than motivation. Growth-focused individuals in 2026 think in terms of systems, not events. They plan years ahead, accept slow progress, and avoid emotional decision-making. They understand that real financial progress often feels boring, because it is built on repetition, discipline, and patience. Money grows best when it is treated as a tool rather than a goal. When income is earned ethically, spent intentionally, and allocated toward ownership and productivity, growth becomes a natural outcome rather than a gamble. In 2026, the biggest difference between people who steadily grow money and those who struggle is not intelligence or starting capital. It is decision sequencing. Many Americans do the right things in the wrong order. They invest before stabilizing income, expand lifestyle before building reserves, or chase trends before understanding fundamentals. Growth improves dramatically when actions follow a logical sequence. A practical starting point in 2026 is income stabilization. This does not mean earning a perfect salary. It means having predictable cash flow that covers essentials with margin left over. Without this base, every financial decision becomes reactive. Americans who build stability first reduce stress, avoid forced selling of assets, and make clearer long-term decisions. Stability allows patience, and patience is a financial advantage. Once stability exists, the next step is intentional allocation. In 2026, smart allocators treat every dollar as a worker. Some dollars are assigned to current needs, some to protection, and others to growth. Protection includes emergency reserves and appropriate insurance coverage that prevents a single event from undoing years of effort. Growth allocation focuses on ownership and productivity, not speculation. One common mistake in America right now is confusing activity with progress. Many people constantly move money, switching accounts, jumping between assets, reacting to headlines, without improving outcomes. In reality, consistent ownership in quality, productive areas often outperforms frequent changes. In 2026, financial noise is louder than ever, and ignoring it is a skill. Another widespread error is overconfidence in short-term forecasting. Predicting exact market movements, policy shifts, or price swings is unreliable. People who base decisions on precise predictions usually take unnecessary risks. Those who succeed focus instead on resilience. They build structures that can perform reasonably well across different scenarios rather than perfectly in one imagined future. In America's 2026 environment, long-term ownership works best when paired with patience and contribution. For example, employees who combine career growth with partial ownership through equity participation, retirement structures, or profit-sharing arrangements benefit twice, from income and from business expansion. This alignment reduces dependence on a single paycheck while remaining grounded in real economic output. Small business ownership continues to be one of the most powerful tools for controlled growth. What has changed is accessibility. Digital infrastructure allows individuals to reach customers nationally without physical locations. However, sustainability matters more than speed. Businesses that grow slowly but maintain customer satisfaction, compliance, and ethical practices tend to survive economic shifts better than those chasing rapid expansion. In 2026, many Americans underestimate the financial value of competence. Becoming highly reliable in a specific area, whether technical, operational, or creative, creates leverage. Reliable people are offered better terms, more responsibility, and higher compensation. Over time, competence compounds just like capital. Another critical area is consumption awareness. Companies invest billions to influence spending behavior. Those who grow money learn to recognize emotional triggers in advertising and social media. They delay decisions, compare value rather than image, and avoid upgrades that do not meaningfully improve quality of life. This restraint does not feel dramatic, but it quietly frees resources for growth. Geographic flexibility is also playing a larger role in 2026. Remote and hybrid work allow income to be earned in high-value markets while living in lower-cost areas. Americans who strategically choose where they live often gain faster financial progress without increasing effort. This is not about deprivation. It is about alignment between income and expenses. Education remains a strong investment when chosen carefully. In 2026, targeted learning, focused on skills that increase productivity or revenue, is far more effective than broad credentials with unclear outcomes. Short programs, certifications, and practical training often produce better financial returns than long, unfocused paths. The key is applicability, not prestige. A major mindset shift in 2026 is understanding that financial growth is non-linear. Progress often comes in plateaus followed by sudden jumps. Many people quit during plateaus, assuming failure, when they are actually building foundations. Those who persist through slow periods often experience disproportionate rewards later. Another mistake many Americans make is isolation. Growth accelerates when people share ideas, collaborate, and learn from others who are disciplined and ethical. This does not mean following crowds, it means selective association. Conversations influence decisions, and decisions influence outcomes. Risk management is also misunderstood. Avoiding all risk limits growth, while unmanaged risk destroys it. In 2026, the balanced approach is calculated exposure, only committing resources that can remain invested without causing stress. Emotional comfort matters because panic leads to poor decisions. One overlooked factor in financial growth is health. Medical costs in America remain high, and poor health often forces financial compromises. People who invest time and resources into maintaining physical and mental well-being protect their earning capacity. This is a long-term advantage that rarely appears on balance sheets, but has real financial impact. Another important principle is gratitude-driven discipline. People who appreciate progress rather than constantly comparing themselves tend to make calmer, more rational choices. Comparison fuels impatience, and impatience leads to errors. Sustainable growth is built quietly. As 2026 progresses, technology will continue to automate tasks and reshape industries. Those who adapt, by learning to work with systems rather than against them, will find new opportunities. Resistance to change is costly. Thoughtful adaptation is rewarding. The right way to grow money in America is not mysterious. It is structured. It begins with earning through contribution, continues through intentional spending, and expands through ownership and productivity. It avoids shortcuts, respects time, and prioritizes consistency over excitement. When money is earned through value, managed with discipline, and grown through patience, results follow naturally. Not overnight, not dramatically, but steadily. In the American system of 2026, this approach remains one of the most reliable paths to long-term stability and progress.